So imagine for a second that you could buy a fully functional, high-performance vehicle for, less than the actual cost of the raw steel it takes to build it from scratch.
Right. I mean, that just sounds mathematically impossible. Or like a complete scam.
Yeah, exactly. It sounds ridiculous. But in the world of commercial real estate right now, that is exactly the kind of anomaly we're seeing in one specific sector. So welcome to the deep dive.
Yeah, glad to be here. I think if you're a limited partner, an LP investor listening to this, you probably already know that familiar sting of the traditional syndication pitch.
Oh no, the classic glossy PDF in your inbox.
Exactly. You get the drone footage of a sunny apartment complex, those really aggressive hockey stick growth charts. And then buried somewhere on page 40, you find this massive layered cake of general partner fees.
Right, the fees that essentially guarantee the sponsors get paid, whether you, the LP, make a single dime or not.
Yeah, it's basically the standard operating procedure for the industry. And honestly, it's a structure that has left a lot of LPs dealing with some serious fatigue, both financially and psychologically.
Definitely. I mean, we're in an environment right now where investors are getting these completely unexpected capital calls because some floating rate debt blew up on a speculative renovation.
Or they're locked into, totally illiquid deals for 5 years while operators just sort of hide behind confusing K-1 tax forms. The alignment between the people managing the money and the people providing the money is, well, it's just been fundamentally broken for a long time.
Right. Which is exactly why our source material today is so fascinating. We are unpacking a presentation for an opportunity called the Clear Sky Industrial Fund 1.
Yeah, and the mission here is really to dissect how this specific fund is attempting to rewrite all those traditional rules we just talked about.
Exactly. We're looking at what appears to be a radically new standard. I mean, an actual paradigm shift in how commercial real estate funds are structured and how LP risk is actually mitigated.
But, that requires a really heavy dose of skepticism because in a world of information overload, literally every single sponsor claims they are, quote unquote, aligned with their investors.
Oh, for sure. It's the most overused buzzword in the syndication space.
Right. So the question we really need to answer by looking at their actual mechanical structure is whether this is a genuinely new approach to capital preservation or just clever marketing meant to soothe an anxious LP base.
I am approaching this with a very healthy amount of suspicion. If Clear Sky Industrial Fund 1 is truly doing something radically different, we have to start at the bedrock.
The asset class itself.
Yeah, exactly. Before we even look at their fee structures or their claims of alignment, we have to look at what they are physically buying. And their entire strategy rests on one specific asset class, which is industrial real estate.
Which is, an asset class that rarely makes the front page of the financial news. It's not sexy. But the data in our sources is virtually impossible to ignore.
Yeah. Tell me about those numbers, because they jumped right off the page for me.
So if we look at the last decade, right, from 2015 to 2025, industrial real estate has just quietly outperformed everything else. It posted a 12.4% average annual return.
Wow. And just to put that into stark perspective for you listening, the total national property index composite average during that same time was just 5.3%.
Right. Less than half.
Yeah. Retail sat at 3.2%. Office space was a dismal 1.1%.
Mm-hmm.
And if you zoom in on just the last 5 years, industrial rents have grown 8 to 12% annually.
It's incredible consistency.
It really is. But, numbers on a page don't explain the reality on the ground. What is the actual physical mechanism driving that kind of relentless demand?
It really comes down to massive structural shifts in how the physical world operates. So first, consider the e-commerce expansion. U.S. e-commerce is projected to grow 8 to 10% annually straight through 2030.
Which means a lot of physical boxes.
Exactly. Every time you click buy now, that physical product has to be stored in a physical warehouse. It usually moves through 2 or 3 different industrial touch points before it ever reaches your front porch.
Right, so the logistics chain is expanding massively.
Mm-hmm.
And then you have the massive influx of capital into domestic manufacturing, right?
Yeah, the onshoring trend.
Yeah, the supply chain shocks we experienced globally over the last few years completely upended that old just-in-time inventory model. Companies realized, hey, we cannot rely entirely on overseas shipping.
They got burned too badly.
Exactly.
Yeah.
So they are actively onshoring operations. They're stockpiling inventory domestically, which obviously requires massive amounts of square footage.
And beyond those macro global shifts, there's also the highly localized service economy. Think about the growing number of trades, HVAC contractors, local plumbing fleets, regional electricians.
Yeah.
These businesses are booming, and they physically cannot operate out of a Class A office building downtown.
Hmm.
And they can't exactly park a dozen commercial vans and store heavy machinery in a residential driveway either.
No, the HOA would have a field day with that.
Right, so they absolutely require industrial zone space with, roll-up doors and concrete yards.
Which brings us back to that raw steel analogy I mentioned at the start. Our sources highlight a concept they call the cost gap advantage, and it really explains why these local contractors are forced to rent rather than build.
This is such a crucial point.
It is. Right now, it costs between $120 and $200 per square foot just to build new industrial space. And why is that? Because you're fighting municipal zoning boards for increasingly scarce land that actually allows heavy truck traffic.
Yeah, nobody wants a warehouse in their backyard.
Exactly. NIBism is real. Plus, you're paying inflated costs for commercial-grade steel and concrete, and you're battling severe labor shortages in the commercial construction sector.
And that friction loop is entirely bypassed by Clear Sky's strategy. They are stepping in and buying existing, stabilized industrial assets for anywhere between $25 and $100 per square foot.
That's wild.
Yeah, they're literally acquiring the concrete and steel for a fraction of its replacement cost.
So when we look at that 8 to 12% annual rent growth, it isn't some speculative bubble. It's just basic math. As long as building new construction costs 2 to 4 times more than buying an existing property, rents are inherently forced upward.
Precisely. The local roofing contractor cannot afford to spend 2 years and $3 million building a new facility, so they have to rent the existing inventory. That captive demand drives the value of those existing buildings higher.
Okay, so the macroeconomic foundation is undeniably strong. But this is exactly where we need to look closer at the GP and LP dynamic. Because historically, when an asset class performs as well, general partners use that rising tide to hide a multitude of sins.
Oh, absolutely. A strong market makes it very easy for sponsors to justify incredibly bloated traditional fee structures. The rising property values mask the fact that the operators are skimming massive profits off the top.
Right. And this is where Clear Sky Industrial Fund 1 claims to be instituting a paradigm shift. So let's look at their actual structure.
Okay, so the standard industry model is heavily front-loaded. A typical syndicator might charge a 2% acquisition fee on, say, a $10 million property.
Okay.
That means the GP makes $200,000 the day the deal closes. They get paid before the roof is inspected, before a single lease is renewed, and regardless of whether the property actually performs for the LP investors down the road.
Right. Well, when I reviewed the Clear Sky presentation, I had to reread their fee structure section like 3 times to make sure I wasn't missing a hidden asterisk.
Pretty shocking.
Yeah. Their structure lists $0 in fees.
Yeah.
No acquisition fees when they purchase a property. No asset management fees while they run it. No disposition fees when they eventually sell it.
Which is an absolute anomaly in the syndication space. Nobody does that.
I'm looking at this zero-fee structure, and frankly, my instinct is highly suspicious. If they aren't taking acquisition fees and they aren't taking management fees, how do they even keep the lights on? Are they running a charity? Are they going to cut corners on property maintenance just to save a few bucks? Like, what is the actual catch here?
The catch is a radical realignment of how they survive. They utilize a 60-40 equity split in favor of the LPs.
Okay.
But the critical mechanism, the reason they don't need those front-loaded fees, is that the GPs literally do not get paid until the LPs get paid. Everyone receives distributions together from the very first dollar of cash flow.
Okay, but in a lot of syndications, especially massive multifamily value-add projects, cash flow doesn't start for a year or two because they're renovating half the units.
Yeah, exactly.
So if the GPs here aren't getting a management fee to survive that dry period, how long are they waiting to eat?
They aren't waiting, and neither are the LPs. The fund projects monthly distributions starting within 30 to 45 days of a close.
Oh, wow. That fast.
Yeah. And the only way they can mathematically do that is by exclusively purchasing stabilized properties that are producing income on day one. They are underwriting to current actual performance.
Got it.
They are not waiting 12 to 60 months for some speculative business plan to play out while just sort of hoping the macroeconomic environment doesn't shift against them.
See, this brings up the psychological pain points of the LP investor. LPs are just exhausted by the heads the sponsor wins, tails the LP loses dynamic.
Yeah, the moral hazard is huge in traditional funds.
Right. Because if a traditional deal goes completely sideways, the LP's capital is wiped out. The GP might lose their reputation, sure, but they just walk away, spin up a new LLC, and start a new fund. They don't lose their house.
No, they don't. But Clear Sky seems to be addressing this head-on with how they handle debt.
Yes, the debt. The source deck notes that the GPs personally guarantee all required recourse debt for the fund.
Right, and we should explain the mechanical reality of that for the listener because that is a massive differentiator.
Yeah, please break that down.
Okay, so if a property has recourse debt and the investment completely fails to the point of foreclosure, the bank doesn't just take the building. The bank has the legal right to go after the personal assets of whoever signed the guarantee. Their personal bank accounts, their homes, their kids' college funds.
Wow.
Yeah. By taking on that recourse debt personally, the GPs are absorbing the ultimate risk. As an LP, your exposure is strictly limited to your initial investment. You have zero personal liability. But the GPs have their personal balance sheets entirely exposed.
That is the ultimate proof of conviction right there.
Truly.
And they're also seeding Clear Sky Industrial Fund 1 with 2 of their own performing joint venture properties right from the start. So if we synthesize this, the GPs don't charge front-loaded fees. They only make money from the asset's actual monthly cash flow alongside the LPs, and they personally guarantee the debt with their own assets.
Right. So the mechanical reality is that they physically cannot afford to buy a bad deal.
Exactly. And that structural reality completely dictates their acquisition strategy. When failure means personal financial ruin rather than just, a missed quarterly bonus, your filter for new properties becomes a fortress.
Yeah, you are no longer incentivized to buy a mediocre property just to collect a 2% acquisition fee at closing.
Yeah.
You only buy when the math is undeniably in your favor.
So let's examine that fortress. They call it their buy box. And it is essentially a massive funnel of rejection.
Yeah, the funnel of no.
Yes. The data shows they spend $5,000 to $10,000 a month on marketing across 5 different channels. So direct mail, cold calling, email campaigns, brokers, and finders.
That's a lot of outbound effort.
It is, and that massive net generates about 30 to 40 leads a month. Out of those, they might get 2 under contract, and after intense diligence, they only close on 1.
So for every single property they say yes to, they reject hundreds.
Hundreds. To maintain that level of discipline, they utilize 9 strict criteria. A property must meet at least 6 of them to even proceed to the diligence phase.
Let's break down the mechanics of a few of these metrics, starting with size.
Okay.
They target buildings that offer 5,000 to 30,000 square feet per tenant
Why that specific window?
because it completely engineers out single-tenant concentration risk. You aren't relying on a 500,000 square foot Amazon mega warehouse.
Right, because if Amazon decides to relocate down the highway.
Exactly. Your massive building sits empty and you default on the loan. But by targeting smaller multi-tenant spaces, if a local plumbing company moves out, you only have to replace 10,000 square feet of income, not the whole asset.
That makes a ton of sense.
Yeah.
And the physical requirements are equally rigid. They mandate a building age of 1980 or newer to avoid the massive capital expenditures associated with aging infrastructure.
But the ceiling height metric is the most telling. They require 16-foot clear heights or above.
Yeah, I saw that. Why is 16 feet the magic number?
Because modern industrial logistics rely on standardized forklift reach limits and specific vertical racking tiers.
Oh, I hadn't even thought of that.
Yeah, if a building is only 14 feet high, a commercial tenant loses an entire horizontal layer of pallet storage. The space becomes functionally useless to a growing business that needs to maximize its footprint. So anything under 16 feet is basically considered functionally obsolete in today's market.
Okay, then we have the financial metrics. They demand a 9% cap rate going into the deal. And for the listener, a cap rate essentially measures the unlevered return.
Right, no debt factored in.
Exactly. So if Clear Sky bought the building in all cash, without a mortgage, the property would generate a 9% annual return just from the existing rent.
Setting that specific floor means they don't have to rely on the magical thinking of future market appreciation to make their investors money.
Right. The property is inherently profitable the day they buy it.
And tying it all back to the construction cost gap we discussed earlier, their absolute ceiling for purchase price is $65 per square foot. They just flat out refuse to pay inflated premiums.
So when you combine all these strict metrics, you get a highly engineered portfolio. The fund targets 12 to 20 properties, housing 20 to 30 different tenants, spread across multiple markets and multiple industries.
Diversification on every level.
Exactly. Think of the traditional LP experience. Often, you're taking $100,000 and putting all your chips on one massive 300-unit apartment building in a single city.
Yeah. And if the major employer in that town leaves, or if a pipe bursts and floods 3 floors,
Your entire investment is in jeopardy. That is highly concentrated risk.
what Clear Sky Industrial Fund 1 is offering is essentially a diversified mutual fund of physical assets. Because your capital is spread across multiple buildings, tenants, and geographies, no single bad deal or single evicted tenant can sink the overall fund.
And that systemic downside protection is what anchors their targeted returns. Let's talk numbers really quick.
Sure.
They're aiming for a 7 to 8% 5-year blended cash-on-cash return, a 15% plus internal rate of return, which measures the annualized compound return, and a 1.5x equity multiple.
Meaning a $100,000 investment aims to return $150,000 total over the life cycle.
Exactly. And for LPs tired of complicated tax burdens, they estimate a 20 to 30% year-one depreciation, providing immediate tax benefits subject to your individual circumstances, of course.
Right. But, you know, an investment thesis is ultimately just a piece of paper. The execution is entirely dependent on the operators.
Yes. This is my favorite part of the source material.
Yeah, if we want to understand how such a precise zero speculation system was built, we have to look at the two principals running the fund, Tyler and Drew.
This is where the entire structure really starts to make logical sense. So Tyler brings over 9 years of experience in industrial real estate with a $16 million plus portfolio.
Yeah.
But his background is what really matters here. He's a former commercial construction engineer.
Right.
He has personally designed and managed hundreds of industrial warehouse projects ranging from 12,000 to 300,000 square feet.
So he possesses a really granular technical understanding of structural loads, roof lifespans, tenant build-out costs, all the stuff that usually bites operators who only know spreadsheets.
Exactly. And then you have Drew. He brings 15 years of corporate leadership, manages a $12 million portfolio, and created a massive 2,000-member real estate investors association.
But prior to real estate, Drew was actually a doctor of pharmacy and a hospital administrator.
Right?
He spent his career entrenched in meticulous operations, strict triage protocols, and intense financial auditing.
An engineer and a hospital administrator. I mean, it sounds like the setup to a joke, right?
It does.
But the practical application is fascinating.
It completely explains the entire ethos of the fund, because engineering and hospital administration are two of the most heavily regulated, inherently risk-averse fields in existence.
Oh, absolutely.
When you're calculating the load-bearing capacity of a concrete tilt wall or managing emergency patient care protocols, you do not guess.
You can't. Lives are on the line.
Exactly. You do not speculate on future outcomes. You rely entirely on proven systems, redundancies, and absolute downside protection.
Right. Tyler and Drew have just taken that zero tolerance for error mindset of their previous careers and applied it directly to commercial real estate syndication.
So how is this systemic approach translating to the real world right now? Let's look at their current flight path.
Yeah, the presentation outlines their immediate goals.
Yeah.
The overarching target for Clear Sky Industrial Fund 1 is a total asset value of $25 million, funded by a $9 million equity raise from LP investors.
And they are already moving. As of the spring 2026 timeline of the source material, the fund already holds 2 properties with a total asset value of nearly $3 million.
And those assets are currently yielding a 7.4% cash-on-cash return, right?
Yes, to date.
Okay, so right now they are actively raising $1.3 million in LP equity for a specific acquisition in South Bend, Indiana, which is targeted to close the first week of May 2026.
And we should look at this specific deal because it perfectly illustrates the strategy in action.
Definitely. So the purchase price is $3 million. At its size, that means they are acquiring it for roughly $35 a square foot.
Wow.
Yeah. Again, compared to the $120 to $200 it costs to build new, they are buying it for literally pennies on the replacement dollar.
And physically, it passes their fortress test with flying colors. It features 18 to 22-foot clear heights, well above the 16-foot minimum.
Right.
It offers 14 dock-high doors for semi-trucks and 13 grade-level doors for standard vans, which just provides incredible versatility for any potential future tenant.
But the financial alignment is really the key here. It is stable and cash flowing on day one. The underwriting shows that several current tenants are actually paying under market rents.
Which is great.
It is, because it provides a built-in opportunity to increase the net operating income when those leases come up for renewal. They can force appreciation through basic, competent property management rather than relying on some risky, capital-intensive renovation project.
It is the perfect encapsulation of the entire paradigm. Buy the concrete below its replacement cost, ensure the cash flow is immediate, and engineer out the downside risk through strict structural discipline.
So if we pull all these mechanical threads together, the core proposition for you, the LP listener, is pretty profound.
It really is.
Clear Sky Industrial Fund 1 is offering access to the quiet structural winner of commercial real estate. But they are doing it by entirely discarding the broken syndication playbook.
Right. You aren't paying a GP a massive fee just to acquire a building.
Exactly. You are getting monthly distributions starting immediately
Right.
because the asset's already stabilized. Your downside is insulated because the operators are personally guaranteeing the debt.
Hmm.
Your capital is protected through massive multi-property diversification.
And the entire machine is run by two guys whose backgrounds basically dictate a methodical, zero speculation approach.
It is a genuinely rare structure in this industry,
Truly rare.
which leads to something we actually haven't touched on yet, and something I want you to consider as you evaluate your own portfolio. We talked about the current demand for these 5,000 to 30,000 square foot warehouses being driven by e-commerce and local trades.
Right.
But looking forward, as AI logistics and autonomous drone delivery continue to aggressively localize our supply chains, the demand for these hyperlocal last-mile industrial spaces is only going to intensify.
Oh, without a doubt.
So are we looking at a future where local industrial real estate becomes as universally necessary and as fiercely guarded as municipal utilities?
Man, that is a fascinating trajectory to think about. And, if Clear Sky Industrial Fund 1 actually proves that this zero-fee, hyper-aligned model works and that it generates superior risk-adjusted returns by force and discipline buying, it begs the ultimate question.
What's that?
Will the rest of the commercial real estate industry be forced to abandon its bloated fee structures just to compete for LP capital?
That's the million-dollar question. Only time will tell if this single fund sparks a permanent industry shift. But thank you for joining this deep dive. As you review the glossy pitch decks in your inbox this week, we invite you to question the status quo, demand true mechanical alignment from your operators, and look really closely at the fine print. See you next time.